Welcome to Business Middle East. This week we're discussing the repercussions of the recent Bank of England meeting and, in Business Snapshot, a glimpse of future oil prices from OPEC's confidential report. The Bank of England met on what was dubbed Super Thursday amid hopes that Bank Governor Mark Carney would have something positive to say on interest rates. But despite a series of good UK economic data over the past few weeks, Carney surprised markets with an unexpectedly cautious tone, disappointing investors. Analysis of that in a moment, but first, let's take a look at what happened in the meeting.
The much-anticipated Super Thursday showed that the Bank of England is in no hurry to raise interest rates. In its latest meeting, the bank hinted at the possibility of extending the current QE programme and even cutting rates if needed. It reduced its long-term inflation forecast, saying the 2% target might not be reached until 2017.
The committee nonetheless expects that the overall pace of UK-weighted global growth to be more modest than we had expected in August. There remain downside risks to our global outlook, including a more abrupt slowdown in China and in emerging economies more broadly, given high levels of debt and vulnerability to capital outflows.
Following on from his remarks, sterling fell by around 1% against all of the major currencies, reflecting the disappointment of investors whose hopes for a rate hike were dashed once again.
For analysis of the Bank of England's decision, joining us now is Noor Eldeen Al-Hamouri, Chief Market Strategist at ADS Securities in Abu Dhabi. Noor, despite a series of positive figures in the United Kingdom, there was a cautious tone from Mark Carney. How did you interpret the meeting?
Even though Mark Carney sounded very cautious, this is a very good thing. The Bank of England proved that it's very transparent, unlike some central banks, hinting that it's very early to raise rates and saying it will keep them lower for longer until 2017. The current period needs more transparency. This is what the market is asking for, and it's needed in order to stabilise the markets.
Since the beginning of the year, the pound has remained stable against the dollar. What's your forecast for the pound heading towards the next meeting of the BoE?
The British pound remains within the same range between $150 and $155 since the beginning of this year. The range is likely to continue throughout the year unless the UK economy surprises us with significant positive figures, especially for inflation and growth. If that happens, it would reinforce the bullish, positive outlook for sterling.
Stay with us, Noor, as we take a look in Business Snapshot at OPEC's confidential report, which revealed oil prices are expected to remain low in the coming years. That could mean major challenges ahead for the GCC countries. Here's the story.
OPEC's confidential report, revealed by Reuters, showed that demand for oil will remain under pressure in the next few years. The report indicates that OPEC's market share will rise in the long term with the decline of shale oil production and natural gas, but that prices will be low. That means that OPEC's crude will rise from $55 a barrel now to about $80 a barrel by the year 2020. Iran and Algeria have suggested that OPEC return to its old policy of propping up prices, but that's unlikely to be approved by Saudi Arabia, which adheres to a more long-term approach. The next OPEC meeting is on the 4th of December. Analysts expect further controversy over the organisation's current strategy of defending its market share rather than supporting prices.
Noor, OPEC seemed pessimistic about the future of oil prices, as stated in the report. How can the GCC countries meet this challenge?
OPEC's pessimism has been there for about a year now, but this does not mean we're going to see very cheap oil prices or a major decline towards $25, for example. This is not on the table for the time being. Most of the negative factors have been priced in already during the year, as we noted in August. We believe that a stabilisation is more likely, and this is what's been happening since August. Oil is trading within a range of approximately $5 up and down, and is likely to continue that way throughout the year. As for the GCC countries, we noticed that many of them have taken some measures, such as deregulating fuel prices. Moreover, Saudi Arabia has postponed some of its future projects, issued local bonds, and increased the water prices on corporates. These measures are likely to support their budgets in the short term. We should not forget that Gulf countries' debt is very low, which gives them the ability to borrow again, as they did after the financial crisis in 2008, to finance their needs until oil prices recovered.
So
we believe the GCC countries are able to overcome such challenges.
Thank you, Noor. See you next week. That's all for now. Share your thoughts with us on Facebook and Twitter using the hashtag BusinessMiddleEast. See you next week.